top 150 dealer groups own about 26% of the total dealerships in the US. And that's just a 3.5% gain in market share over 5 years. So in 5 years, top 150 dealer groups, which has moved around a little bit, has only increased their market share by 3.5%. And at that pace, and this is based on rooftops, it would take until 2060 for them to double their market share, 35 years.
Hi, everyone. I'm Jason Stein, Managing Director at the Presidio Group, joined here today by George Karolis, President of Presidio. Great to be with you, George.
You too, partner.
You know, we had such great response and demand for content from dealers who were present at NADA recently. We decided we'd like to share it with the industry. Presidio has invested heavily in thought leadership. We built a team of media, research professionals, partnered with folks like NCM, with the goal of arming stakeholders with the best possible information as they navigate today's auto retail market. We've heard from dealers and industry leaders that one of the biggest challenges today is obtaining accurate and timely data. The goal of this presentation is to set the stage on where data is derived from and also give you some insights you may not already know, stuff that's unique to Presidio. Presidio conducts its twice annual dealer sentiment survey, run in a very tight window with over 3,000 dealer respondents. And as previously mentioned, we also established a partnership with NCM Associates, allowing us access to aggregated financial data from over 4,000 dealers. Our team has also built out an extensive proprietary dealership database with real-time data of every dealership in the United States. So lots to go through, and today we're going to talk about the state of the market in general, as well as M&A trends, and we have a lot to share with you. So with that said, let's dive into it with our own expertise. Let's get into the M&A market update now. This is where you received a ton of feedback. People just wanted to know more about what you were sharing at NADA, and I want to start with fragmentation. 30 years ago, the market was characterized as highly fragmented, right? You're here to say not much has changed.
That's right. When I actually started my career around 30 years ago in the auto industry, and that term was thrown around regularly. The industry is highly fragmented. Publics were just coming to be. Consolidation was just starting. And we are basically still in that same realm. Industry is still highly fragmented. We look at the dealer census and let's say the dealers that own between 1 and 10 stores, and that's 95% of the dealer body. So 95% of the dealer body owns between 1 and 10 stores. And interestingly, in that data, about half of those dealers own just one store. When we look at sort of, let's say when we get a little bit more into consolidation, we'll look at groups, medium-sized groups that own 11 to 50. Well, that's just 4% of owners, about 279 owners, but about 25% of dealerships, right? But those aren't necessarily all consolidators, because we see most of the transactions that are occurring that are sort of medium size in that bucket. And then we get to the larger groups, and we'll just define that as over 50 dealers, and that's less than 1% of dealer owners. Less than 1%, just 24 owners own more than 50 stores, and it's about 11% of the dealerships. So if you want to draw the line and say that's consolidation, more than 50 stores, and again, there's no wrong or right answer, that's just 11% of the total dealerships in the U.S.
That's remarkable. You have a fascinating stat that takes us out to 2060 as well.
Yeah, I mean, as we talk about the top 150 dealer groups, because most of the industry likes to report on that, Automotive News Awards and others, we look at our database a little different than that, because we've spent thousands of hours really drilling through the entire census in the U.S., and there are a lot of dealers that don't self-report. But it's all similar, right? And the top 150 dealer groups own about 26% of the total dealerships in the U.S. And that's just a 3.5% gain in market share over 5 years. So in 5 years, the top 150 dealer groups, which has moved around a little bit, has only increased their market share by 3.5%. And at that pace, and this is based on rooftops, it would take until 2060 for them to double their market share, 35 years.
Let's consider consolidation. How is consolidation really defined, George?
Yeah, it's, as I just talked, it's really hard to pin it down, right? Because just when you think consolidator, things change. A lot of us recognize some of the large groups on this list, and all of them were considered top 150 dealers. And yet, over the last 5-6 years, and interestingly enough, they all have one thing in common: they all sold, and that's 10% of the total, right? Top 150 groups have changed hands just in the last 5 years as well. So it's ever dynamic and ever moving around as well, and it's really hard to pin down. So consolidator can become consolidated as well.
Let's talk about transaction cadence. over the last 5 years? Give us your view on that.
Yeah, sure. If we look at pre-COVID, as this slide shows, pre-COVID transaction volume levels, we saw the industry kind of moving at a pace of about 335 dealerships sold per year, about 200 transactions. And we saw after COVID hit, starting in 2021, which is the first full year, that pace pick up by over 80%. And so we're now running at a consistent level of close to 600 dealerships that are changing hands per year and about 400 transactions. But what's really interesting about that data is the number of transactions and the number of buyers. And so that post-COVID, that last 5 years or so, was about 3,000 dealerships that changed hands combined. And as we look at the unique buyers of those dealerships, and you'd think it was just a couple hundred different buyers. We hear the same names over and over, the Publix and some of the large groups. Yet, interestingly, it was nearly 1,000 unique buyers for those 3,000 transactions. So a very robust and dynamic industry with many more buyers than sellers.
A lot of talk of public groups. How much capital have they deployed, and what does that mean for the dealer base?
Yeah, we call this the flywheel effect, and this is actually what's fueling that transaction cadence, that high level pace of deals that are occurring, and the number of buyers out there. And we call that the flywheel effect. So we saw, and the public companies are a great example with this slide. We saw the Publix deploy about $25 billion in capital on acquisitions over the last 5 years or so, which is nearly 430 dealerships that were acquired. But interestingly, you think, well, their cash would have dried up because of all that spend, yet their liquidity more than doubled from $673 million to over $1.4 billion over that period of time. And their EBITDA also grew significantly. It more than doubled. It grew by 130%, actually. These deals yielding more earnings, more cash flow, creating a flywheel of more cash available to deploy and buy acquisitions, right? And so we saw that have a positive effect on the cadence and the transaction volume as well. And if we extrapolate what the Publix spent and the number of stores they bought across that 3,000 dealerships that changed hands, that's nearly $175 billion deployed across all the deals over the last 5 years.
So a lot of potential buyers out there chasing a small number of deals, right? That's the state of the market these days.
That's right. If we look at our survey, we saw nearly 60% of dealers that responded say they're interested in acquiring dealerships over the next year or so. And that's, that's a majority, and that's significant deal activity, and it sort of proves the point that there's a lot of unique buyers and a lot of interest in sort of a buyer and seller demand imbalance. Of course, off to the right here, we asked dealers if they were interested in selling. Not many dealers ever say they are until they're sellers, right? And so, but I think the interesting part about that is as we extrapolate that across, the dealer transaction volume that we just talked about, that means that there's nearly 4,000 buyers poised for growth. Now, it may not be that high, but the survey results, which is a statistically valid survey, extrapolated across the transaction volume and dealer interest, suggests that could be as many as that many dealers.
Let's talk about geography and maybe desire versus reality.
Well, yeah, no surprise here. Dealers surveyed, shocker, majority want to be in the Southeast. Well, that's where Florida is and a lot of the red states and business-friendly states, and also Southwest, which has Texas, right? And so a majority of dealers, number one and two, raising their hands saying, hey, we want to acquire in the Southeast and Southwest. You see a lot smaller fraction there and smaller numbers indicated in the West, Northeast, and then a little higher in the Midwest. But interestingly, when we look about where deals actually transact, and this slide shows a heat map of all transactions over the last 5 years, those 3,000 dealerships that changed hands, we see a different story. We see a lot more activity outside of the Southeast and Southwest. And so when we match this up to the survey data, interestingly, we saw what's happening in reality not necessarily align with what's desired. So we saw nearly double the pace of acquisitions versus desirability in the Northeast and Midwest and West, and then a lot lower number. Although the Southeast was still the highest overall, we saw that 40% desire go to 26% actual, and more deals kind of happening in those states where there was lower desire. So a little mismatch there, in terms of dealer desire versus actual.
So we've talked about where they want to buy, but what do they want to buy and who's moving up and down?
Yeah. So when we look at brand desirability now, after geography, we look at our dealer desirability survey, and of course, the top 10, no surprise here. We've got Lexus and Toyota right at the top, but nearly 50% of the desire brands being the top luxury brands. We've got Honda, Subaru in here rounding out. We saw Mercedes actually tick up a little bit, and that's a lot of positivity from new leadership there and getting through their sort of product cycle issues. And then we actually saw Ford enter our top 10 for the first time to round it out. So a lot of exuberance with the key import brands, Toyota, Honda, and Subaru, of course, but luxury still also leading the pack with nearly half of top dealerships in terms of desirability being luxury. Focusing on luxury a little bit because that's mostly the most desired segment. It's really interesting. We look at here on the left, total public ownership of all dealerships in the U.S. about 5%. But when we look at their ownership of luxury segment, it's 20%, so nearly 4 times higher on luxury. So the public's own 5% of total dealerships, nearly 20% of luxury stores in the U.S. And we look at the top 150 groups, we see also a higher relation on luxury. So they own about 26%, as we said prior, of total stores in the U.S., yet over 50% of the total luxury dealerships. And that's the 6 main volume luxury brands. And so when we marry now geography and brand and focus on luxury, we see that even more profound. So we see and this is the top 30 largest metros in the U.S. here on the left, we see more than half of the stores owned in the top 30, luxury stores owned top 30 geographies and metros in the U.S. owned by the top 150 groups, and about 28% of that owned by publics. And off to the right, we look at Florida and Texas, the 2 most desired states, and we see that even more profound. We see nearly 2/3 of all luxury stores in Florida and Texas owned by the top 150 largest groups, and 28% owned by the public. So a huge focus by the largest groups on luxury, and we're seeing that in our book of businesses. There's no end in sight to that.
All right, let's talk about what's on everyone's mind now. Valuation. Give us your view of that.
Valuation's top of mind for dealers, and a lot of talk about multiples. It seems to be the thing that dealers want to focus on a little bit too much. We do publish multiples. We publish them twice a year for the industry. And look, they're a good barometer, kind of to compare deals to one another. But multiples are, an output of years of opinion influencing. And they've become a little bit of a self-fulfilling prophecy and a little too much focus on multiples. And they're not necessarily aligned with reality at times. Why? Well, blue sky multiples, brand multiples, they've been in a tight band, tight range for a long time. They haven't really moved much over the years, and I'll get into that a little bit more here. They're more a barometer about how brands are valued within ranges of each other, and they're an indicator of what the market believes multiples should be if earnings were correct. And I want to say that again. They're an indicator of what the market believes multiples should be if earnings were correct, right? And the issue is earnings. It's all about earnings.
Right.
And there's not ever one simple answer and one kind of right answer on earnings, right? Earnings are different for every dealership. Some underperform, some are overperforming. And so those things have to be adjusted. And there's a lot more that goes into it. But, but I'll talk a little bit about some of the changes to our multiples, again, to be used as a good barometer as you compare brands and deals to each other. We took Porsche down a little bit at the end of the year. They've got some sort of short to midterm issues on production and allocation and some tariff-driven issues, and they're a little, stringent on their facilities, impacting dealers, which is sort of tougher in a lower production and inventory availability environment. We also took Audi down some as Audi's been under pressure with also product and tariff-related issues, and sort of an identity issue over the next couple of years until new product rolls. We took Mercedes up, as I talked about prior. New leadership in Adam Chamberlain, an amazing guy, is really kind of pushing that brand forward here, and got a lot of great confidence back from the dealer body. And they've got some really great inventory and really an iconic brand, of course. And also Kia, a real positive brand, great dealer relations. They got some strong refreshed products coming out, and we're seeing a lot of demand across the industry for Kia stores. And finally, Ford. We took Ford up a little bit as well. They've listened to dealers and done a great job. Have had a strong dealer dealer board with Eddie Stivers that ran that up until last year, and their F-150 is a powerhouse, and they've just done a good job listening to dealers and have a lot of positivity coming back here to market. So again, subtle changes to multiples because the largest part really is the earnings, which we'll talk about here in a second. As if pinning down historical earnings is hard, projecting sustainable future earnings, which is really how you think about valuation, is even harder. And so touching on that earnings issue even a little further, no single dealership in the U.S. has the same earnings profile. Significant differences based on actual earnings. And so how could multiples be that easy to apply? Well, alternatively, there's something that we look at and publish as an alternative way to triangulate valuations and take the earnings noise out of the equation. And that's revenue multiples. They're not to be used in a vacuum, but they do take that earnings EKG sort of and help sort of soften that and minimize the variation in earnings from dealers. And so as we go to the next slide, there's a high correlation between brand sentiment and valuation. And this matrix here shows off to the top right quadrant here, the higher the multiple and the higher the brand sentiment, it's good to be in the right quadrant. And the green line here in the middle shows that the closer sentiment and multiples are to each other, the more on par they are with valuation. So there are a couple of things that sort of stick out and some outliers. We look at Toyota because they are number one in brand sentiment. They're at the top, and they're trading sort of like luxury stores, so to speak, right now. But that's okay. They're allowed to. There's a high demand for Toyota stores. A little bit of an imbalance right now in terms of valuation and brand sentiment. And so there's a couple head scratchers here. Brands that have me thinking, for example, Porsche. Well, number 7 in brand sentiment, below Mercedes, BMW, and Lexus, yet their multiple is on par, if not higher, right, than those. And so you sort of question that, and that's why you see a little softness in valuations there. Kia, we talked about, very positive. Well, on the trend line, they're trading well below their peers. They're trading below Subaru and Honda, for example. Audi, not a lot of great news out there, but ironically, sentiment actually suggests that they're trading lower and people are valuing them lower than what sentiment suggests. And so, this is a good barometer for things, but no secret that dealer sentiment and dealer desirability amongst brands is highly correlated to multiples.
How about the blue sky multiples in the last decade versus the average public dealership group?
Yeah, as I talked about a few seconds ago, multiples have not changed all that much in years. And if we look here at this slide, and this is over the last 10-year period vis-a-vis published multiples, overall, the average blue sky multiple, the median blue sky multiple, has only moved about 0.8 times, so less than 1 time, over 10 years. Mm-hmm. And we look at public company data, and this is through September. Their EV to EBITDA multiple from pre-COVID until today has only changed 0.4 times. So not much movement in cash flow multiples, blue sky multiples.
In your view, what does it say about earnings versus multiples?
Well, it's all about earnings. That's our view, right? It's all about earnings, and earnings is a much heavier piece of the equation. Not necessarily what earnings say on a dealer financial statement, but again, what the appropriate earnings of a dealership should be in terms of valuation. And you can see it with this cool cartoon. It's a true story here, actually, right? And again, it's about the reliance on multiples versus the truth about what earnings are, and they're from two different lenses. So look at here, the seller, let's say the dealer on the left in this slide, thinks he got 10 times. He said, I got 10 times. He thinks he hit a home run and got a great deal for his business. And the buyer here, who has a different lens on what the earnings and potential of that dealership is, believes he paid 5 times, right? So, again, if I had $1 for every time a dealer asked me, what's my multiple? Multiple of what? Multiple on what? You can get numerous different answers there.
Our slide got a lot of laughs in the room when you showed this at NADA.
Right.
Our valuation matrix highlights the fact that valuations are much more complex than most state. Is it art and science, growth potential?
Well, it's an art and science. Like valuation's an art and science, real sophisticated, right? And again, every dealership is unique, and no one dealership is the same in the U.S. Brand and geography are key drivers, as we've been talking about for years, key drivers. But the earnings profile and sustainability of earnings is a missing link. And that's really the most important part as we talk about valuation, right? And so another cool cartoon
This is a good one.
Yeah. If a picture is truly worth 1,000 words, right? And this is indicative of our daily conversations with the different dealers and buyers and sellers out there, right? So, and let's look at this. This is interesting. So, look at dealer on the left here, and this is, let's say, this is the actual dealer who's quote selling their business, and this dealer believes that his dealership makes a certain amount of money, not necessarily what is reported, but dealer believes, hey, I make $3 million. We look at the dealer in the middle. Let's call this dealer buyer number one. Well, this dealer's going through the numbers, running it through their model, and believes that this is a $2 million store, not a $3 million store. Says I have to value this as if it's a $2 million dealership. And dealer on the right, he doesn't really care what any of these other dealers are saying. He's looking at his lens and his model and his applying his expertise, and believes this is a $4 million profit dealership. And again, this happens every day. Not one dealer looks at value and earnings potential from the same lens. Guess who probably wins out on acquiring that dealership? Dealer on the right. And looking at it on this slide from a different view, these are two examples. On the left here, historical earnings, and on the right, potential future performance, right? Future earnings. No one dealer looks at that the same. And we see this on a daily basis as we're active in the M&A markets. On the left here, you get the actual earnings of a dealership here in the middle, and a buyer and a seller's view on what those earnings are. So oftentimes we see buyers and sellers not even agreeing on what the historical earnings run rates are. And that's even exacerbated as we look at future. We take three different buyers that are viewing this from their own lens, and they'll typically come up with three different assessments on what they think those earnings levels of that dealership and opportunity is, which drives differences in values. And so, interestingly, as we apply this concept of the importance of earnings versus multiples, right, and the importance of sustainability in future earnings as they should be, right, as they should be for that brand, we've kind of mapped out here the transactions we've been involved in over the last year or so. And here, if we look at where they traded vis-a-vis actual published multiples and the actual historical earnings, we see a majority of the deals that they actually traded above the published multiple range. Some traded in range, and of course, there's always an outlier here or there. But when we go to the next slide and we look at revenue multiples and use that same data, well, a majority of our dealerships that traded hands that we were involved with traded right within those revenue multiple ranges. So again, those revenue multiples, a different way to look at things, take those the differences in earnings and all that noise out of the equation, and really come to brand value of what that brand and that actual dealership is really going to be worth in the market.
All right, Presidio talks a lot about portfolio management. You talk a lot about it. You shared that at NADA. It fuels growth. Where is it best exemplified?
Yeah, I mean, if you look at, we've been honored to represent some of the largest companies in the industry in their portfolio management, helping them sell stores, if you will, efforts. And we see that being a key component of the driver of M&A today. Quite frankly, a majority of the deals that we'll be closing here in the first half of the year are all related to portfolio management initiatives from our clients and large companies. The public's top 150 groups in particular sold nearly 400 dealerships over the last 5 years across 260 transactions. These are growers. These are dealers that are growing and acquiring, yet they sold nearly 400 dealerships, right? It's a real prudent trend that we're seeing some of the best dealers employ as they grow, right, to optimize their portfolios. So if we look at sort of some of the drivers of that, well, why do folks sell businesses on the next slide here? Well, of course, we'll see sometimes a diversification. So too much in one brand, too much in one market. So brand and market segmentation, right? We also see, and market allocation, we also see real estate issues driving that sometimes. Not wanting to invest in a big capital expenditure project, a renovation that may not yield an ROI. I think the biggest driver we'll see is on the leadership and sort of workforce side of things, where with this, the 80-20 rule really comes into play here, right? Where oftentimes you see large groups having to divert too much effort, put too many resources, especially on the personnel side, into a dealership that may not be optimizing and that may be taking too much time vis-a-vis the allocation of their portfolio. And then oftentimes, more smaller sort of driver is, a large company will hit a framework agreement cap on our brand. Will they have to sell a store? For example, we helped Asbury sell a Lexus dealership a couple of years ago when they hit a cap with some of their acquisitions, right? And then purely from an ROI perspective, we'll see some prudent owners look at an imbalance sometimes in the earnings that are being generated and the value it's creating for their dealership versus what the market values it at, where they believe selling it makes more sense from an ultimate ROI perspective.
All right, George, in conclusion, where do we go from here?
Yeah, look, recapping this discussion and some of the output from these slides, industry consolidation will continue, but it'll take decades. As we talked about earlier, top 150 groups could take 25 more years to double their share and own over 50% of dealerships, and we'll see some groups move in and out of that over time. This growth flywheel we talked about is going to accelerate M&A activity and fuel it for years to come. As groups grow and generate more cash flow, they'll have more to invest in additional deals. Imbalance in the market in terms of buyers and sellers, we'll see M&A market remain highly active and highly competitive with nearly 10 times the number of buyers and deals available, at least for the time being. Portfolio management is going to be a key focus from some of the larger groups with dealerships focused on ROE, return on effort, that'll drive their strategic vision going forward. High margin businesses, as we talked about earlier, will be the key driver and key focus, fixed operations in particular, over the near term and long term. There's risks to the franchise model that are abound and will continue to be paid attention to, and the model will continue to evolve. We didn't focus a ton on this today, but we are aware of concerns about direct sales models and Chinese brands and threats and growth of online and used vehicle retailers for just among a few, right? But ultimately, technology and productivity, we're going to see that a key focus here and top of mind. We're going to see AI continue to improve and evolve, and ultimately improving the customer experience and driving dealership operational efficiency that'll help counterbalance any future changes and challenges in the market.
Lots to digest and plenty to look forward to. George, thanks so much for the time today.
Thanks, Jason.
Thank you.